of the particular scenarios or cases for angels and for founders where this situation is more beneficial rather than damaging?
Well, again, I think if a company, so I agree, if a company is growing, right, and it shows a clear growth trajectory, and you can almost see these interventions as bridges between more consolidated fundraising efforts that have a much more structure to them, right? And they bring, let's say, they would bring in institutional investors, and let's say you see much clearer the various rounds parsed across, at yearly intervals. Then and people show milestones that are being met and the company being growing, then in essence this creates a bit of a linearity in what would have otherwise been a step function, right? My valuation is now 500, then it's going to grow to 1.5, then it's going to grow to 5. You see, there's nothing magic about this step. And what happens in between? Well, what happens is that in principle, you should use the money and use it judiciously, grow the company threefold, and then you raise it 1.5. But sometimes it doesn't work like that, right? So sometimes you do need these intermediary steps. So if these if an agile round becomes an intermediary step, it's fine. But if what it does is it becomes a replacement for a down round, and then again it's an up round, and then again a down round, then I think yes, also for accounting reasons, it becomes difficult for anybody who is an investor, but also for the, I guess, the sanity of the angels who are going to say, well, I don't even know whether I get diluted or not diluted, depending on what's happening, right? So that constant dilution versus growth of your equity share probably also gets some people less comfortable.
Confused, yeah. Okay. So, and what's the attitude of VCs, and particularly, that's a question for Konstantin. What's the attitude of VCs towards this approach? And do you see, since you represent a global company, do you see the evidence that this approach becomes more popular globally in other regions rather than just in the UK?
Okay, as a VC, well, I have very mixed feelings about agile fundraising, no surprises here. Let's admit that some founders like fundraising, but most of them really hate it because it distracts them from building the product and growing the company. And that's why if there is permanent fundraising, this is actually never-ending torture for the average founder. That's why I think that this mode could damage the company. But sometimes it's necessary just because there is no other way to attract funding. And I think, let's say, for very early stages, agile fundraising is really applicable, especially when you're trying to raise money from angels and very small VCs. And then it works fine. But then if your company matures, then it becomes really harmful for the company because, fundraising is very time consuming, but not only because of legal paperwork, and the SeedLegals help to optimize this thing, and it's work great. But this is about convincing people, and it always requires time of CEO, the founders, and you can't scale it. All founders have 24 hours a day. And if they don't build the product, don't grow the company, then, what will be the company in the next month? That's why I think that it's very important for founders to be focused on company building, not on fundraising, actually. The ideal situation when the company don't need to fundraise at all, or maybe raise one round and then continue to grow, and so self-funded or funded by customers' money. That's the best way. So actually, I think that, fast-growing startup is some kind of a high-speed train, not a city taxi. So less stops for new passengers it makes, the faster it arrives to the final destination. But in the very beginning, founders, may not know the final destination, and that's why this taxi mode is okay. You could go between different agiles, and you will try to find your product market fit and so on, and it's okay for the very beginning of the company, but then you need to be focused, you need to scale the company, and you don't need to spend a lot of time on fundraising, trying to meet everybody who expressed interest in your company. And that could be some, I think, harmful implications. For example, imagine you're a founder and you would like to raise, for example, £1 million, and you could raise it from one VC or could raise it from 40 business angels. And if everything goes well in the future, then it's totally fine. But if something goes wrong, for example, some pandemic appears in the world and your plans crash, then you will need additional funding. And it will be much easier to raise money from these investors than from new investors, and it will be much easier to raise money from these investors with deep pockets, like institutions, like VCs or family offices, or other kind of investors, than from many smaller investors. And especially when you have fragmented cap table, you don't have any particular investor who feels responsible for the company, because let's say when you invested 1 million in one company, you care about it, and it will be harmful for you to write off 1 million. But if you invested 25,000 in one company and there are 40 people who did the same, then nobody cares about writing off 25,000 if they're professional investors. And then nobody will care about helping you to raise new funding. So that's the potential trap of this agile fundraising from my point of view. And well, in the United States, for example, where there are a lot of such cases in Silicon Valley, and people used to raise money via safe notes for many years, since the moment when Y Combinator introduced it. It used for pre-round funding, but then at round it closed, and then you behaves like a, let's say, typical startup with typical timelines of 18 months for between first and second round, and between second, third, and so on. So you, let's say, as a founder, you have 12 months of pure work on product and growth, and then you have 6 months for new fundraising. That's typical scenario, and it works even with SAFE and with all these popular convertible notes which appeared in Silicon Valley. I think it's good to have such legal instruments in Europe and to be, and that they are becoming more and more popular, but it should not change the scheme a lot.
Okay. Thank you. Have you ever, I mean, you personally encountered such deals. Have you ever done this, or no? I mean, this negative attitude towards
well, we invested in SAFE, we invested in convertible loans, but finally they all converted into equity round.
Maybe
So there is no, let's say, pure agile fundraising company in our portfolio. They all at some point converted into equity, and the founders try to focus on real work, not on talking with investors.
Do you feel that at least the request for pre-round funding or post-round funding is appearing more frequently from founders, or not?
Well, not really. For pre-round, sometimes it works for seed stage when you have a lot of unquantifiable risks and a lot of things which are very hard to measure. And sometimes it's easier to just raise some convertible loan and then agree on firm valuation a bit later. But well, I can't say that it's really popular in our portfolio, and especially when it is not used for post-round funding. I mean, post-round funding is something which is not really expected. So founders, when they try to raise a round, they don't plan to have some bridge loans and so on. This is something which is used for when things goes not according to the plan. Because, for example, it requires more time and more money to reach some milestones for the next round, or COVID happens, or any other things happens, and so yeah, it's not in the plan of any founder, I think.
Thank you. As far as I understand, there is a kind of new major type of startup investor occurred lately in the last decade. As far as I understand, family offices are investing, the investment of family offices into startups, tripled over the last 15 years, or I don't remember the exact figures from the reports, but anyway. So what is the attitude of family offices towards startup funding by itself, and particularly investing this way, more opportunistic way? Vahe, would you please comment on this?
Yes, good evening. So I hadn't heard of this term before. It's not a phrase that I've come across, and it's never been mentioned within our family office community. So I decided to, before this webinar, in fact, I'd never heard of this term until this webinar came about. So I decided to get in touch with some of the members of our community who I know are active in the startup space, and got in touch with 10 single family offices, and none of them had heard of this term before. But when they looked into it and looked at the definition and so on, they had come across the concept before, but just not known as agile fundraising. As Konstantin kind of referred to, it appears to be more common in the US. And there's a similar kind of investing concept in the US called SAFE, which he referred to, which is a simple agreement for future equity. So without determining a specific price per share at the time of initial investment. So it appears it's a similar type of concept, and it allows the entrepreneur founder to get money quickly without really setting a valuation for the business. And certainly it might make sense from the founder's point of view, as fundraising is hard and time consuming. And if you typically raise a lot of money for a 3-year plan, let's say, you might also not need all of that money straight away. So why kind of raise so much initially? However, I think the general perception was that, it is more friendly towards the entrepreneur and less friendly towards the investor. Also, fundraising is time consuming, and this has been touched on by Jonathan as well. It is time consuming, and this needs to be balanced with the entrepreneur actually focusing on the business. Especially if they're fundraising continuously. That's always a concern for the investor, and why it might be preferred to go down a more traditional route. And finally, also, I think it's family offices that I spoke to thought it was better for the entrepreneur to have cash in the bank up front in general. So for example, when there is a time like this, when we're going through a pandemic, and it is harder to raise money, it helps them keep going, and they don't have to worry as much and hunt around for more money.
I think you can probably thank Isabella and Anthony from SeedLegals for coming up with the agile bit of agile fundraising. I suspect.
Yes, this term was first introduced by SeedLegals, but SeedLegals is a major force in this process, so we caught up. I see. Okay. We have few questions from the audience, and let me read them. First, do you think agile funding could force entrepreneurs selling equity at a lower value just to make ends meet? How does it reflect on their long-term valuations? I think many of you have already touched upon this, but would anyone want to answer? Jonathan?
Yeah, happy to jump in. So I think it feels like we're all kind of heading towards the same way, in the sense that I think agile fundraising is one of the options that entrepreneurs have on the table. And it feels a bit like, if you can close your round and raise a whole bunch now, great. And if you can't do that for one reason or another, then clearly it's better to close the round early and to get the money in the bank. I think we can all agree on that. And clearly VCs and other institutions prefer everything to be at once. But if you're an entrepreneur and you have no other choice, then clearly money now is better than money later. So I think that's one element of it. The question around the valuations and whether you therefore accept a lower valuation now, all the instruments that are available, the majority of the instruments that are available, the whole point is to delay the valuation discussion. And so for an entrepreneur, the most common that we have when we speak to companies is if they want a valuation of 5 million and the VC or the investor wants a valuation of 3 million or 4 million, the delay or the a convertible loan note or another instrument is a great way of saying, you know what, we'll simply raise a small amount now. We won't set a valuation, but in 6 months down the line, if we hit our metrics, this is the valuation that we get. And clearly that has some advantages for the entrepreneur because they get money now and it delays the valuation, but it has some disadvantages for the investor, such as some of the points that Konstantin talked about, i.e. when the new investor comes in, they might not be able to benefit from the discount. So I think, no, the answer is it doesn't force you to accept a lower valuation if you can delay the valuation. If you can't delay the valuation and you're raising little smaller amounts, then I think that it might have an impact, because typically if you're raising a big chunk, you can execute more on the vision. You can stop worrying about raising money. I think Manuel touched upon that. Fundraising is a really difficult aspect. If you're psychologically always talking about and thinking about fundraising, you can't focus on the business. So I think if you can delay the valuation, great. And if you can't delay it, it probably will have a negative impact on your business if you keep having to marginally increase the value.
Mm-hmm. Okay.
I think you're I think you're kind of probably already having a discussion about value anyway at the beginning. Because if you're an investor, you're going to commit to, let's say, 100 grand now. 6 months later, you're going to get another 100 grand which you're going to commit to. First of all, as an investor, as a family office, there has to be some kind of performance criteria to hold the entrepreneur accountable, which I think you referred to earlier. Secondly, I noticed there's a point about due diligence that goes two ways. One, the entrepreneur has to make sure that person is good for that extra 100 grand in 6 months' time. But also as a family office, is it really worth spending all that time doing that due diligence? And that's why quite a lot of family offices don't actually get involved in startup investing. But as an investor, you will want, if you're putting up the 100 grand, you will want some kind of discount as you're making that commitment, and you don't want to pay a higher valuation for putting money in the second time around, because obviously if you're putting money in the first time around, you are automatically driving up the performance higher anyway. So an advantage for an investor potentially is that you would negotiate an X amount, I don't know, 20 to 30% already. So really you're kind of already having a valuation discussion anyway at the beginning.
Okay, thank you very much. We have a second question from Mark Hernandez. When raising a specific round, it's a match to achieve certain goals and targets over a period of time. As an investor, I see a big risk on investing just a percentage of what's really needed to bring the startup to the next level. This approach only allows the startup to plan very short term, as the guaranteed runway is just a percentage of what it is supposed to be. How can you overcome this risk for investors? Can you at all? Anyone who would like to answer? Konstantin?
I don't think that it's actually this risk is manageable. So I mean, when you invest just smaller portion, which is not enough to reach next level, it's some kind of, it looks like a Ponzi scheme, because your actual return as an investor depends if any other investor will invest shortly in short term. Actually, if nobody invests, then you lose everything because the company will go bankrupt. So that's some kind of Ponzi scheme.
Okay.
and that's why, I don't think that it's fundamentally manageable. And also I think that and it's also about valuation. I mean, it's very risky scheme, because when you have all investors, let's say, invested at one time in the round, then as a founder, you would like to increase the valuation, but after discussions with many investors, given the fixed state of the company, you will end up with some, let's say, fair valuation, something which is accepted by the market, by many investors. And then you will close the round. But if you have evaluation one by one in small tranches, then there could be some problems which will lead just to destruction of the company, because when you raise, let's say, it's $1 million valuation, and then you signed one customer which you as a founder very excited about, then you could find an investor business angel who would put money at, let's say, $100 million valuation just because he also is very excited. But then it will totally harm your story because you won't raise next round. And that's actually additional risk. And I mean, as for example, from business angel point of view, if I invest in the round, I know that there are other investors who also in line with me in terms of valuation. When I'm the only investor investing, and especially if I'm as a business angel, I'm not, let's say, very professional, maybe I'm not an institution, then, well, my risk is very high.
So
yeah, I think that.
Sorry, go ahead.
So from our end, what we are trying, can you hear me?
Yeah, we can.
So from our end, what we're always trying to do is we're trying to ensure that a round gives the entrepreneur about 12 months of runway. So all the angels that we work with are quite interested in seeing this runway, right? So we see a little bit less of this patchy approach, or if it is a bridge, then it's a clear bridge. But generally, what we are trying to do is find a way to really provide that runway, because otherwise, again, this is what we hear loud and clear from all the angels. You cannot really build a company in sprints of 1 month at a time. So that, and it drives the entrepreneur crazy as well, because again, it's as if he's getting a salary from the equity holders, right? So that doesn't really work very well. And by providing that runway, then you can really have ups and downs, which are normal, because otherwise you really assume a rectilinear thing, which is almost like an issue tree that every single decision needs to go positive. Otherwise, the whole thing breaks down, right? You're in another scenario. And I think that there's another element here where, because more angels work together on agreeing on a valuation before they actually start investing, you see that the terms are pretty much the same for all the angels that invest in a specific round. There is a copy of what was named before as the market value, right? So everybody agrees on the market value, and they do quite a bit of due diligence. And this valuation is rarely very far off the chart of a bunch of fundamentals, and whatever these fundamentals are depends on the company and depends on the heuristics and so on. But in my experience, we haven't seen valuations that go so far off that in a month you start saying, oh my god, what have we done, right? So the combination of ensuring a valuation that seems sound based on everything that is at stake right there, and the runway gives both angels and the entrepreneur a pretty good aligned incentives to proceed.
Okay. Isabella, you wanted to add something?
Yeah, just a financial mitigation. I think the thing that people forget, the difference between the convertible loan note and the SAFE and the ASA is simply that the ASA is SEIS and EIS compliant, right? So if an investor is, putting in, let's say, 150K on which he gets a 50% tax break, as well as, potentially 10 to 20% discount on the shares when they do convert in the round, like that tax break on its own can mitigate quite a lot of loss. And that's one of the reasons that convertible loan notes don't do well at early stages, because they're not SEIS and EIS compliant. Whereas, particularly, and remember, like, obviously, Jonathan and Konstantin and Vahe, like, they all work at a little bit higher level, but at a very like early stage, when you're raising from 250K to like 1 million or 2 million, like that SEIS and EIS fund is incredibly important. So that risk factor is slightly mitigated by that tax break. That, do you know what I mean? It's taxable income anyway. So that's also a reason that investors do tend to go for it as well.
Okay. I think that we can wrap up, but at the end, I would like to have a sort of lightning round. The key takeaway that the audience should have a sort of impression of this approach for the startup and for investor? What could be the key outcome of this panel? Or would you please answer each of you? Vahe?
Yeah, key takeaway seems to be it's more beneficial towards the founders and the entrepreneurs. Family office level, I would be skeptical. Maybe it's more high net worth angel investors who could benefit from things like the EIS and so on. So, but let's see. I mean, it's a new concept, right? So you never know. Awareness needs to be raised of it, and see what happens. Yeah.
Thank you, Konstantin.
Yeah, I would like just to remind what I already said, that please think about the startup as a high-speed train. So it could have many stops at the very beginning, but the less stops it makes in general, the better. So that's why the less rounds it has, the better.
Okay, thank you. Manuel?
I think it is a good instrument when taken in together with the other instruments that an entrepreneur has. So it's great to provide flexibility and something that gives them this flexibility that is required sometimes for cash flow reasons. But if this becomes the single operating model, that can distract them significantly from business, and it also can deter angels who know that what they need is a larger amount to get to the next step than the small amount they go for because it's easy.
Okay. Thank you very much. Jonathan?
Sure. So I think for earlier stage companies, it's a fantastic option available to get cash now. If you can't close a bigger round from angels, the more growth you have, and actually the bigger round you raise, you may be more beneficial not to have this longer fundraising cycle and just to raise a big 2 million and a big 3 million check outright. But for angel money and for early money, if you can't afford to wait 3 months to close the round, then clearly it's a very beneficial thing to do to have cash in the bank now.
It looks like all of you are in this sync, you know, there's even almost nothing to argue about. Isabella, could you please add something?
I suppose to anybody who is a founder that's here, put yourself in the position that, you know, maybe there's another lockdown and you're deferred. I think you don't want to be held hostage by your investors and the fact that they know there's a timestamp on your documents. I think if you think that, you know, the person you're going to get into bed with the next 10 years does not have your best interests at heart, this kind of tool is very effective for you to be able to have the flexibility to be like, actually, I can raise more and it doesn't have to be with you. So from a founder perspective, which is obviously what we kind of support at SeedLegals, if you have a strong company and you don't want to be held hostage by a timeline, I would suggest it. But, you know, if you're not a strong company, you kind of won't raise investment regardless. So yeah, I think definitely embrace the flexibility here that's offered.
Thank you very much.